Welcome back. In this session I will talk about modeling default risk before looking into one particular way of measurement. The challenge is that most things that could go wrong we know very little about. We have to make quite a few assumptions throughout this process. And people that try to quantify losses are really, of course, in a difficult position, because many things we can try to quantify are what we call an expected loss. So given our modeling, we could derive expected losses, but of course this assessment is always flawed, because end of the day we don't know what is happening if things really go wrong. Now here I just discuss this relationship. So an expected loss depends on different components. It depends on the risk of default, so that's the first part. So what is my expected default risk? Now again, of course, that has to be derived somehow, and what people use is a combination of different methods, and we will talk about this in more detail. The other element is, of course, now if something really goes wrong, what is my exposure? Now the actual exposure to a default depends on many factors, including, of course, the precise nature of the debt you gave to a company. Yeah, so for instance, seniority matters. So what's the ranking of creditors? Are you in one of the first ones, or are you one of the last ones? So that depends a lot, and this also defines exposure. The other element is given default, what's the recovery? Yeah, so loss given default means that now if default happens, how much can you recover? Now the issue there is that's hard to know. And again, it depends on the type of debt. So for instance, if you talk about a mortgage, you will have a collateral. Yeah, so you have a collateral in the form of real estate, so a fixed asset. Now if the company goes bust, well, you can then of course use the collateral, and you can try to liquidate that, and depending on the type of collateral, this might be sufficient to cover your principal and your interest payments. But you know, these factors are hard to quantify, and the main difficulty in this equation, in my experience, is the last component. So what can we say about recovery rates? We just know very little. And the thing is that all of these components, they are treated as independent, but actually they are not. Yeah, so a company that is at very high risk of default might have also very low recovery. So these are not independent processes, but they are treated as if. Yeah, that's the trouble. So by multiplying them, I actually treat them as if they're independent. And this is very often in models how we do it. And I will talk about this more in our additional session in April. So the main challenge stays, how can we quantify these different components, and in particular what can we do about unexpected losses? Well, the honest truth is not an awful lot. So what you do in practice is you try to quantify a probability density function. That gives you a potential outcome under certain assumptions, and of course these distributions, they are usually far away from any normal distribution that could be described just by an expected value and a variance. So you might need to go into higher moments, or very often you just do it empirically. Yeah, you just you derive a distribution from a model, and then you just talk about different cutoff points. Yeah, so we can have to discuss stuff like value at risk, or a plausible range of values under certain conditions. Now, in the end, it is quite difficult to assess this problem And the models we are currently using are to some extent, of course, flawed. It's not straightforward. In particular, the main challenge is still to do this assessment for smaller companies, because you deal with very limited information here. Now, credit ratings, and we spoke about them before, they try to do this work, and they of course focused on the default risk, not on recovery. That's done in a separate way. So they focus on the default risk component, combining qualitative and quantitative information. We already discussed some of the issues, but the main struggle, of course, as an outsider is, well, we have to rely on how these institutions operate. And we already spoke, there are maybe different incentives at play, and you might question the independence of rating agencies. And also, end of the day, a rating is what you might call a black box, because we don't know exactly what's behind it. Yeah, so we don't get full disclosure. The reports you receive from rating agencies, of course, will outline why they made a decision, but they don't give you full data access. It's very rare you get this access. In fact, in one of the projects I worked on, we had this access with Moody's, where we could look at their database, and that was in the context of understanding credit risk and climate change risk, because they now increasingly try to incorporate these factors into their assessment. So I talk here more about the Moody's rating process because I know more about Moody's than S&P. They, of course, they will follow similar approaches, but of course not all of it is always open to public scrutiny. Now, the main challenge you have when it comes in particular also to information you can quantify based on financial statements is that the figures you see in financial statements have to be all adjusted. And there are lots of things that can go wrong. In this particular course, I don't really focus too much on the firm perspective and issues such as off-balance sheet items, which all of course matter, like say operating leases, for instance. We can always have a discussion about these issues, but this really goes very deep into equity analysis, which is beyond the scope of this course. But I just of course have to mention it here. Then you have a whole host of qualitative elements in this assessment, and quite a few of these elements, we will get back to them when we talk about the issue of impact in investment, and of course the exposure to climate risk, for instance. Yeah, so one big exposure here is what happens to changes of regulations. So it's very, very likely that, of course, policy changes will lead to a change in regulations. For instance, it might be much more expensive to have high carbon emissions. And such changes, of course, will have a tremendous impact on companies in terms of their growth and their profitability, the two value drivers, which then has, of course, a knock-on effect on their abilities to meet their obligations. So that there might be a higher default risk because of that. Also, change of technology, again, it's something you would look into and you would assess, which again, of course, is closely related to the current regulatory environment and potentially driven by policy changes. Now, the internal rating systems of these institutions try to judge these qualitative and quantitative aspects of risk, but of course it is always difficult as an outsider to assess how this is really done. So when I worked in consulting and I worked with Moody's, so I have a little bit of an insight, but of course also for us we have limited abilities to really scrutinize any information. But what you always need is a combination of industry expertise and analytical abilities. So that's the key issue. Yeah, so you have to look at, of course, financial information provided by companies. You have to make an awful lot of adjustments to get to the bottom of it. And in the end, of course, industry-specific factors really matter. Yeah, you have to really understand the industry. And when I worked also in consulting, we specialized on industry. So certain people always worked on similar industries, for instance chemicals, and they knew all the things related to that, in particular also in terms of, you know, what's a plausible profit margin, for instance. If you don't know the industry, you wouldn't know. In my case, I worked mostly in banking, and again, of course, banking is totally different from non-financial business. Now, I'm quite sure you came across a value at risk model. So similar approaches are used in the context of assessing credit value at risk. So that's of course another perspective from a debt holder. Value at risk as a concept in risk management can be used on all sorts of metrics. And again, what they try to do is they try to look at the different aspects of credit risk, which we discussed before. And of course, I argued that in the end, all of these things are driven by default risk. Another way to look at this is to argue we talk here about migration risk. And migration means in this context basically a change of credit worthiness. So if a company becomes less credit worthy, or put differently, the default risk is going up, then you would see a change of spreads. So the credit spread would widen, and you see of course a higher risk of downgrades, which again would have a knock-on effect on bond prices. But you know, that's a matter of terminology. So in practice, the term migration risk is used in this context to focus on a transition to maybe a lower level or a higher level of credit worthiness, which affects then bond prices. I provide a very brief overview of credit risk models. Again, of course, one can explore this an awful lot more. There is a long history of these credit risk models, actually going way back into the 1960s. I mentioned the Altman Z-scores, which are still used in particular in the context of small and medium-sized enterprises. Now, credit metrics is maybe one of the most commonly used approach, also in academia, discussed to a large extent. And we will look into this in a bit more detail. So the idea of credit metrics is to look at a period of 1 year going forward and try to assess the credit migration. So basically, going back to the previous slide, we want to see what's the likelihood of a transition in terms of credit worthiness, which of course then translates into a change in bond prices. And this we try to model looking forward by 1 year. So end of the day, what we always have to also understand is any of these models, they have a certain time period they would look at. And of course, the further you go, the more difficult it gets. Well, this is of course an obvious issue in terms of forecasting. So the typical period to try is to aim for a 1 year forecast. Now, there are alternative approaches to that. So some approaches rely more on firm information, more on industry information. Others are more focused on the macro level. So the Wilson model is an interesting one because it is focused more on macro drivers of default probabilities. I have done quite a bit of work on UK companies in terms of default risk, and yes, of course, the macroeconomic environment matters an awful lot, there's no doubt, but also of course government interventions do matter, and you see this in many areas as well. Yeah, so if you only focus too much on the macroeconomics, you might miss the boat a little bit. Yeah, so I give you one example. Now, because of the COVID pandemic, of course, it had a significant impact on macro variables, a disastrous impact, and all the models would then, of course, expect very high default risks. However, most of it didn't really happen, and this is because of significant government interventions. Yeah? So one example is, for instance, in the case of real estate investment, the ban on evictions. Yeah? Big impact for real estate, and of course lots of distortions because of that, which of course affects profitability in the real estate sector. So from my perspective, aiming at the macro level is certainly useful, but it's of course not sufficient, in particular not without looking at policy factors. Yeah, that's an important aspect. Then you see methods which go into what you call the Merton approach. I'm quite sure you came across this before. So that's what is called a distance to default approach. So what Merton does is, Merton looks at the asset structure, liability structure of a company, and uses measures of market volatility to assess the volatility of assets. And if assets are fluctuating too much, the risk becomes higher that you go into an insolvency default, which means that your assets are simply not enough to meet your liabilities. Now, Merton's approach has been used a lot. It's still used a lot. It has been criticized a lot. But the most important criticism, and number one, is that you cannot use just volatility measures from the stock market, which are usually much higher than fundamental values, to assess what happens to assets. Yeah. So what this approach does is it takes market-based measures of variance of volatility, applies them to the assets of a company. Now this is quite a stretch. That's the first stretch. The other important aspect is that the main risk factor is not really running into insolvency, and we spoke about this before. The main risk factor is running out of cash in the short term, so illiquidity, so a lack of liquidity, a liquidity default. That's more of a realistic risk. Of course, when you can argue in this case you should be able to recover your losses, which is of course partly true, but of course there are significant costs and time involved in recovery. Yeah, so usually it takes years, and you go through litigation to get to this point. So one has to also really try to consider that. And then there are alternative approaches which are just there to highlight where these things are going. Again, they focus on migration risk, like credit risk plus, and then there are what you call reduced form approaches, which go very deep into stochastic processes and modeling. I worked on these quite a bit in the last years. It's mostly because of one of my PhD students who worked on corporate bond pricing. We might cover some of these aspects, but it becomes very quickly challenging to do, because we have to then use basically simulations to explore these relationships. Good, I see you in